In this video, we're going to look at U.S. Energy, which is in the oil and gas exploration and production industry. Exploration and production is the early stage of energy production. It includes the searching and extracting of oil and gas. And what I do in my videos is I run my discounted cash flow model to figure out the true value of a company's stock. I also look at their financial ratios and compare them with their competitors. Let's get started with the model. This company has a market cap of $7.8 million. And let's see what they're trading at. They're trading at $5.57. That's one share of stock. Now I'm going to pull the free cash flows. And the way you value a company is you estimate the future free cash flows, and then you discount that number back to today's value. So they have mostly negatives, one positive. We also need the net income, which is the profit and loss on the income statement, and that's negative every year. And also the revenue, which are the sales for each year. And revenue has to be positive. It does make it difficult to value a company with so many negatives, but I did build another discounted cash flow model to figure these types of companies out. Let's look at a capital structure. They have no debt. Let's see what their beta is, because we need the volatility of the stock to calculate the cost of equity. It's 0.55, so they have a low beta, so the stock, it doesn't move too much. So it's a low risk stock. Let's get their current assets. We need this to calculate the current ratio later. And current assets is on the balance sheet. That's cash, accounts receivables, and inventory. 2.7 million. We also need the current liabilities to calculate the current ratio later. These are debts and payables that are due within 12 months. We also need their equity, which is assets minus liabilities. That's 9.2 million. That's a value of the firm according to the balance sheet. And then we need the operating income, which is negative 834,000. Let's look at the capital structure. They're 100% equity, and the cost of equity is 6.5%, and we use a capital asset pricing model to figure that out. That's the discount rate we're going to apply to the future cash flows. So we estimated 4 years of future free cash flows, and it's all zero. But we did a terminal value, which is $553 million. That's all cash flows after year 4. And we discounted those numbers back to today using the weighted average cost of capital. And the way I came up with this was I assumed a growth rate similar to the growth rate they had from 2016 to 2019. And I pushed that out to 30 years. Now, if we take the value of the company, which is $109 million, and we divide that by the 1 million shares outstanding, we get an intrinsic stock price of $78. It's trading at $5.57, so it's trading at a 93% discount. So it's a strong buy according to the model. Simply Wall Street doesn't have a value for this company because their value is based off of what analysts say the stock is worth. And there are no analysts that are looking at this stock apparently. It's a unique situation, and it's very hard to value companies like this. So I use an out-of-the-box kind of approach to figure it out. So there are a lot of assumptions involved. So anything can happen. Let's look at historical stock price. So you can see the stock was trading much higher a few years ago, but that's mainly because they did a couple of reverse stock splits. So I don't think the stock was ever this high. It's just because it appears that high because of the reverse stock split. So it looks like the stock has been trading pretty steadily the past few months. The reason I'm looking at this stock because last week the stock jumped up 50% in one day. So that's why it got onto my radar. You can see right here on the 22nd, it went from about $5 to $7. Let's look at the financial ratios of the company to see if we get more information. They have a negative PE because they have negative net income. They have a great price of sales and a great price to book ratio. So the PE is price of stock over earnings per share, but their net income is negative, so they have a negative PE. The price to sales ratio is price of stock over sales per share. And to get sales per share, it's revenue over shares outstanding. So when a company has a negative PE, people look to the price to sales ratio. And they have a great price to sales ratio. Under 2.5 is what I like, and if it's under 1, it's considered a great value, and they're pretty close to 1. They also have a really good price to book. It's below 1. It's price of stock over book value per share. This indicates that if the company went bankrupt today, it would be able to pay each shareholder $6.58, providing them a decent return. They have a good current ratio and a negative ROE. So the current ratio is current assets, $3 million over current liabilities, so they can cover their current liabilities. ROE is negative because that's income over equity, and they have negative net income. The best way to look at ratios is to compare them to similar companies. I've done videos on Baker Hughes, Canadian Natural, Diversified Gas and Oil, Denbury, Marathon Oil, Occidental, Shawcor, Transatlantic, US Energy, and Whitecap Resources. And 3 of these companies trade on the Toronto Stock Exchange. So I converted their market cap from Canadian dollars to US dollars. So our company's right here, US Energy Corp. And if the number's in red, they're worse than the average. If they're in green, they're better than the average. So they're worse than the average in everything except for current ratio and debt. And they're actually the best of all the companies in those 2 categories. They're the only company with no debt. That's something to really think about, because even though they're a tiny company, they have only 8 million market cap, the smallest of all the companies, with no debt. They may have a lot of room to borrow and get through difficult times like coronavirus, while other companies may go bankrupt because they may not have enough room to borrow. So time will tell. Let me know what you think about this video and this company. Thanks for watching.